Hi, this is Brad Levin, CEO of Legacy Wealth Partners. It's May 23rd, 2018, and I'd like to share with you a very brief recap on the economic and financial markets environment. We're about halfway through the second quarter, so let's take a look at how things are going. So far this year, as you can see from this chart, we've had very little progress in the performance of all the major asset classes through the month of April. The one exception is commodity prices, which have increased primarily due to increases in the price of oil. Yet despite the progress that we have not seen in the markets, we've had a lot of volatility to say the least. In fact, so much so that Jack Bogle, the founder of Vanguard, was quoted saying that he's never seen a market environment this volatile in his entire 60-plus year career. This chart here illustrates what we've seen take place in the S&P 500 index. After reaching an all-time high in January, we experienced a correction into early February, bringing the market down almost 12%. Since then, it has zigzagged across in a sideways pattern up until where we are today. What's contributed to this volatility? Well, there's been a lot of factors that investors have had to contend with, really contributing to a wall of worry. We first had concerns that wage growth, which is a positive, could contribute to inflationary pressures and cause the Federal Reserve to act more aggressively. Valuations of stocks might be too high. There's also the ongoing tension with North Korea, the recently imposed tariffs, which could possibly lead to a trade war, scandal related to Facebook and their privacy controls, and the possibility that corporate earnings, albeit good, may have reached a high water mark. Fortunately, almost all these issues have faded into the backdrop and are no longer issues today at the present. The one concern on the mind of investors right now is the possibility that we could have a trade war with China if the tariff issues are not resolved successfully. But really, we are witnessing a change in the paradigm of volatility unlike we've seen in many years. There's been so many days so far this year where the market has traversed 500 or 700 points even in the Dow Jones in single days. And really what's causing this change to take place is a paradigm shift in the monetary policy of the Federal Reserve. From 2008 through 2015, the Fed was pursuing an incredibly accommodative approach, keeping the cost of borrowing ultra low, which also meant that investors seeking a higher return were compelled to put their capital in the stock market and the real estate market, which of course moved prices higher. But since late 2015, the Fed has changed its tack and is now in a policy normalization environment whereby they have been gradually raising interest rates to take the punch bowl away from the economy. And that has ushered in this new level of volatility. Let's now take a look at the Legacy Wealth Partners Macroeconomic Dashboard. This helps us conceptualize for you, quite simply, the environment that we see for the market environment today. And what I can tell you is that on the chart, all the dials give us a sense of how things are going. Green is good, yellow is neutral, and red is bad. Right now, there's no red on the chart. Everywhere you see a dotted arrow represents what the reading was at the end of the previous quarter compared to what it is now. So we've had improvements in a number of areas, and overall the environment looks pretty good. Let's take a look at corporate earnings specifically. Now, 80% of companies have reported earnings for the first quarter, and we are on track right now to have the highest rate of earnings surprises since the third quarter of 2008. Right now, we are on track for earnings this year to experience a rate of growth that analysts estimate could be more than 19%, and that is a lot. The concern for stock valuations have eased a little bit because with earnings increases, the valuation levels have come down, and the price-to-earnings ratio on stocks right now is just a tad above the 5-year average. Also, the consensus from investment analysts is that the S&P 500 could experience an increase of about 15% over the next 12 months, and that's pretty darn good. One of the things we want to remain focused on is what could bring about the next bear market. This chart shows the 10 bear markets that we've experienced since 1925. And what's important to note is 8 out of those 10 bear markets have coincided with a recession. The bottom line is recessions kill bull markets. If we have a recession, that is what we expect to bring about the next bear market. And what's the likelihood of a recession occurring in the near term? This is the Ned Davis recession probability model, which was developed back in 1979. On this chart, the blue line zigzagging up and down represents recession risk. The critical level is 50. If we get above 50, there's a high likelihood of recession. The gray bars represent actual recessions we've experienced. So the Ned Davis model has effectively predicted all the recessions we've had since 1979. As you can see from the right side of the chart representing where we are now, recession risk is incredibly low. One of the other issues that I want to talk about, though, is the volatility in the bond market. And what we've experienced since last September is an increase in the yields of bonds tremendously. The 10-year Treasury bond yield has increased, in fact, over 45%. Bond prices move the opposite direction of yields, so an increase in yields, which we expect to continue, could potentially bring about the next bear market for bonds. That's a very concerning factor, especially for conservative investors who hold a lot of bonds. Now, what's important to understand, though, about the bond market is this dynamic of the Fed tightening interest rates is unique relative to the rest of the world. The left side of this page illustrates that the majority of economies are actually still very accommodative with their monetary policy, and the Federal Reserve, shown there in gray, is the only central bank that is tightening interest rates currently. So one way to protect against rising rates is through a diversification of one's bond exposure throughout the world. Let's take a quick look at the global economic growth picture. Things are looking pretty good. The global economy is expected to grow close to 3% this year. And this chart illustrates the level of economic growth throughout the world based on manufacturing manager purchases. And what we can see is that there's only 4 countries around the world that are below the critical level of 50, representing a growth paradigm. Anything above 50 is good, anything below 50 is bad. The majority of the world right now is definitely in a growth mode, and that's great. Now, the volatility we've experienced has definitely been unnerving for a lot of investors, and a lot of people have tried to preemptively make adjustments in their portfolio to counteract the possibility we could have a bear market. I really love this quote, though, from Peter Lynch, who has said that more money has been lost by investors trying to anticipate correction than has been lost by the corrections themselves. So what's important to be a successful investor is not to let your views of what might happen cloud what actually is happening. Zooming out from the chart that I showed you at the beginning of the S&P 500, I want to put for you into context how the market looks today relative to its longer-term trend. The blue line here represents the market's movements on average over a 200-day rolling period. And we can see that the market right now is handily above that level, saying essentially that the trend in the long term is still moving up. The market has also recently moved above its more immediate trend line, which is the yellow line representing a 100-day moving average. That also is suggesting that in the near term, the trend also is looking quite healthy. And what we also note is that over the last few months, as the market has zigzagged up and down, each successive pullback has been to a higher level than before, and that's really good overall. At this point, really what I want to say is that the market environment today looks healthy both fundamentally and from a technical standpoint. Here at Legacy Wealth Partners, our goal is to provide confidence and clarity for our clients through prudent planning and robust investment management. Thank you for your time today. I'm Brad Levin for Legacy Wealth Partners.